It's Bank of America's Urgent Alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's urgent advice to all depositors as Bank of America is urging its customers to act now. We'll show you what the big bank is telling its customers they should do and the reasoning behind the sense of urgency to act immediately. Now, let's head over to Bloomberg, where he picked today's story up with a headline: a B of A's Hartnett sees a second half comeback looming for bonds. And this is a big motivation because many of Bank of America's customers and many of the large bank customers are sitting on cash. And B of A's Hartnett, he is one of the best analysts in the business, and he's making a case why it's time to make a big change. Positioning in markets, the next moves in monetary policy and the risk to corporate profits from some weaker signals on the economy have set a scene for a reversal of the anything but bonds trade in the second half. This is a team led by Michael Hartnett, again, one of the best in the business. He pointed to investors being very long on cash, meaning they're holding lots of it, investment grade stocks and bonds, but nobody is making bullish bets on the long bond or the 30-year treasury, which Hartnett sees as the best hedge for weaker nominal growth, suggesting that all these customers sitting in cash could drive some outsized returns in a big way. And while the outlook on monetary policy front is set to be easier, government spending is likely to tighten over the next 12 months, a setup that's positive for bonds, he's suggesting, meaning that the government is likely going to run smaller deficits going forward. There's going to be less bond issuance, and at the same time, there's going to be consistent demand, especially at the long end of the curve, driving not only a potential yield for this, but also a big return should prices rally. And he goes on to say the surprise rally in yields is supportive of leveraged plays such as China, the UK, and real estate investment trusts and utilities. And last October, he said the bonds were set to rally big in the first half this year, while a call that failed to materialize as a strong macroeconomic backdrop, despite higher interest rates, fueled a sell-off in treasuries, while equities powered ahead. But is it time to make that shift for those who are holding cash? Well, the question is, what is the catalyst behind the move now? Maybe Hartnett was a little bit early, but how would you take advantage of that? Well, we give you the signals. These are our top bond trades looking toward the intermediate long end of the curve. And this just goes back to early May. You talk about what people are earning in CDs and cash, and this is on top of the yield. Now, how did we do that? Well, it's really simple. We have two fantastic reports that have outstanding win rates. That means if you took every trade we recommend each week and you put it on the books, you'd be looking at a 92 to 88% win rate. You're wondering, how is that possible? Well, one way we do it is with our CTA Timer Pro. We look at the machine positioning. So Hartnett was early on our call, but we were dead on it. And how do we do that? When the machines are in deep short position and price starts to move against them, that's your opportunity. We give you the signals each week and a video how to trade them based on our own view. On addition, maybe you're a technical trader, you like that, and we take those technical signals, we smooth them out with a proprietary overlay to make it a very clean entry point for you, keep you in the trade longer, make you more money. We do that with a report each day, just like CTA and a video. But here's the best part: you don't have to be an expert on the bond market or anything. What you have to do is sign up for the 30-day trial, start learning, start trading, and now you'll see why B of A's Hartnett is saying the big money could be in bonds, and the opportunity for people to reposition their cash is huge. Because really, when you look at the bond market, it's a function of inflation and growth expectations. So what I took here on this chart is a consumer price index and the GDP for the US, and I merged them together against the 30-year treasury yields. This is where Hartnett says is the opportunity. And you can see that as growth and expectations and inflation come down, well, what happens is yields come down, making big return for bond investors. Here you can see what he's trying to point out is, wait a minute, the macroeconomic backdrop is actually constructive now for weaker yields, but nobody is really looking at that. And as he sees all these deposits sitting in his bank, he's saying, wait a minute, the opportunity is big. But you kind of wonder, how is that possible? What he's referring to is something called duration, and that measures how long it takes in years for an investor to be repaid a bond's price by the bond's total cash flows. But it also measures a sensitivity of a bond or fixed income portfolio price to changes in interest rates. This from Investopedia. And here's the point of how it works is because the higher duration, which you would find on the long bond, the more a bond's price will drop as interest rates rise. And here you see if rates were to rise 1%, a bond with a 5-year average duration would lose approximately 5% of its value. But put that in reverse, which is what Hartnett is suggesting, if interest rates were to drop 1%, well, that's a 5% return on top of the yield. And that's the case he's making here. He says everyone's long cash at the wrong time. And here you see a long duration strategy describes an investing approach where a bond investor focuses on bonds with high duration value. In this situation, an investor is likely buying bonds with a long time frame before maturity and greater exposure to interest rate risk. A long strategy works well when interest rates are falling, which usually happens during recessions. So now the question becomes is Hartnett right? He got his call perhaps a little early, but now the setup, as you see from our reports, but also the economy is starting to change. From U.S. stores to factory floors now, second quarter starts out slow. And this is huge because when we look back to earlier this year and even later last year, what did we continue to hear? It was the second half story. Everyone said the second half of 2024, that no landing, soft landing scenario was going to happen and the economy was going to boom. Investors bought into the narrative. They positioned accordingly, but they still remain in cash in many cases as U.S. economic data has consistently landed on the low side of expectations, suggesting the economy is indeed losing momentum in the face of restrictive monetary policy. But the jury remains out on how quickly inflation will subside to provide some rate relief. Well, the jury just doesn't understand how the bond market works. This is one place that Hartnett's got it nailed. Here you see the consumer price index against advanced retail sales. And we got the advanced retail sales report this week. And here's one of the key things. We look at the CPI as a proxy of supply and demand, but it's a very lagging signal. So you can see here as retail sales growth declines or even goes negative as it did during the global financial crisis, well, what happens to CPI is with a lag, it comes down. And it really makes a lot of sense because if a store cannot move its products, we talked about Tesla yesterday building up this massive inventory. Well, at some point, the solution isn't to raise your prices to move the inventory, it's to lower your prices. It's all function now. Demand is weakening, and that puts a tailwind behind the bond market in a big way. And Americans may also be pulling back as the job market shows signs of softening in April and a strong start to 2024. We're now seeing continued claims tick back up to 1.8 million. And while employers added 175,000 jobs, the fewest in 6 months, while the jobless rate edged up to 3.9%, what we noted is hourly earnings growth also slowed. And this is a big thing because, again, you look at inflation and it's all about demand. If you don't have demand, you cannot continue to get price growth. Yes, employers can raise their prices, but ultimately, if nobody comes in and buys from them, they have no revenue. They have no revenue. Well, they have no profits. They don't have a business much longer. And that's why we also see here that as continued employment claims go higher, well, what it means is inflation, again, with a lag, is coming down. And again, Hartnett's watching, of course, the employment market saying, wait a minute, these 1.8 million now is a number moving higher, not lower. And that is setting up a drop in the consumer price index, which we know at the moment is very sensitive to the bond market. Any signs of relief in consumer prices sends bond prices rallying in a big way. And even the manufacturing sector, which accounts for 3/4 of total industrial production, has had difficulty building momentum amid rising input prices and inconsistent demand. And so what you note here is inconsistent momentum, weak momentum, slowing momentum. And what that tells you is there isn't enough demand in the debt-based economy. So how do you create demand? Well, you do it in one simple way. It's not higher rates. It's lower rates. As the Institute for Supply Management's latest measure of factory activity moved back into contraction in April after expanding a month earlier for the first time since 2022. And here you can see looking at industrial production against the consumer price index, again, making the case for Hartnett's call where he may have been just a little early. Here you can see industrial production in red when it heads down and even worse contracts, which it does on a year-over-year rate of change. You'll notice what happens with the consumer price index with a lag. it comes down. What he's saying here is, wait a minute, industrial production, the labor market is all adding up to an opportunity for people holding large amounts of cash to reposition into the long end of the curve. And again, we give you the tools to do that and a 30-day free trial. Check out those links in the description below, because as we look at the Philly Fed, this coming right out of the central bank's resources, manufacturing activity in the region weakened overall, according to the May Manufacturing Business Outlook Survey. The survey's indicators for current general activity, new orders, and shipments all decline. Now, that doesn't tell you that the economy is booming. It tells you it's getting weaker. Rates are too high here, and with the latter two turning negative. The employment index suggests declines in unemployment overall. Both price indices indicate overall increases in prices, but remain below their long-run averages. So here you have an issue where demand is going down, prices are going up, and eventually we know prices do follow demand in a big way, as do yields. And here you can see, although employment indicators rose, the firms continued to report a decline in employment on balance. The employment index moved up 3 points to -7.9. In fact, 2/3 of the firms reported no change in employment levels this month, while the share of firms reporting decreases exceeded the share of reporting increases. But here's a big one. The average work week index rose 10 points, but remained negative at -8.3. So you have a case where employers are still shedding jobs, they're cutting hours, and that means consumers have even less money to spend. And so the simple answer is higher prices don't work, higher interest rates don't work. If things don't change, we head into recession anyways, and in that case, Hartnett has got the call. Again, maybe a little early, but I think this time he's right on the money. At least our reports validate that. Here you can see, zooming in to the Philly Fed's Manufacturing Outlook Survey, what do you see? New orders in contraction, shipments in contraction, meaning they're getting faster to customers. Unfilled orders. This is dangerous. When unfilled orders run out and there isn't enough new business, the next thing you know, it's not just hours getting cut, it's employees getting cut. And sure enough, what are we seeing here? Number of employees still in contraction as they're getting rid of people, and the average work week going down, meaning less money in people's pockets. And how about this? Prices received, well, they're going up, but nowhere near as prices paid. It shows you there's a supply and demand mismatch, meaning there's going to be too much supply and not enough demand to meet it, because consumers just don't have the money. And that's why we take a look at this average weekly hours against the consumer price index here, again showing the production of non-supervisory employees, this in red. And what you can see is that hours worked go down. What happens? The consumer price index follows it, and it makes perfect sense, because if an employee is getting less hours, their paycheck is indeed shrinking, and if their paycheck shrinks during a period where prices are rising and debt service costs are rising, well, it means they cannot afford to continue spending at the rate they were before. That impacts the discretionary side of the economy in a huge way, leads to lower overall prices and eventually lower interest rates, which is why Hartnett is suggesting, well, maybe depositors sitting on cash should be looking at the long bond. And Al Arian says Fed's higher for longer rates U-turn is at odds with the market, suggesting that maybe the markets are going to drive rates lower here, as the Fed is going to have to pivot, meaning not on the basis of inflation, but on the basis of the real economy. And normally that's exactly what we see. If the Fed actually tracked inflation, then it would be simple. We'd see the federal funds rate move as inflation does, but it doesn't. In fact, the Fed often cuts, and we've shown charts on the show, well ahead the consumer price index falling, because it's all about the economy, which is indeed getting weaker, and he's got it right. And like other market watchers, Al Arian has previously raised the possibility that the U.S. central bank could look beyond its 2% inflation target and a new era of structurally higher pressure on prices and growth. But that isn't the case. What we're seeing is just the lagged effects of inflation from all the pandemic stimulus, and it's coming through the system, but eventually it grinds to a halt when consumers can't afford higher prices. And we're seeing those signs now. We're seeing that at Walmart, we're seeing it at McDonald's, we're seeing it all over the place, at Tesla, Isn't the inflation target the right target? Well, it doesn't matter because, well, the Fed doesn't follow it anyways. We all talk about wanting to go back to 2%, and 2% is arbitrary. In fact, it is. If we're pursuing the wrong inflation target, the risk of mistake, that mistake would mean sacrificing growth unnecessarily. The risk of mistake is high. And that's the point I've been making on the show for over a year, is the Fed is making a huge mistake here, driving interest rates too high, inverting the curves, and they're going to create a situation where there's not enough money being created to sustain both the existing debt and the growth of the economy. We're seeing that happen now. Al Arian is warning that the world's subjected to higher inflation. Maybe that's the case for now, and we've come from a world that's subject to lower inflation, that is less demand. The issue before was the fact that we had enough supply and excess supply to meet demand. And during the pandemic, we didn't have enough supply to meet demand because we gave out a lot of money. Now what's happening is we're seeing demand go down, supply come up. It just hasn't shown up in the numbers quite yet. But how would you know to follow Hartnett's advice to that long bond and maybe reposition cash? It's real simple. Watch the 2-year treasury yield that's shown in blue against the 30-year that's shown in red. You can see when the 2-year falls, well, that means the 30-year is soon to follow it, and with the potential for return based on duration alone, it tells you those holding cash are going to look back and say, why didn't I buy the long bond? And Hartnett's going to be the one that says, well, I told you so. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.